Hi, everyone. Jordan here from Journey Financial. I'm excited today to talk to you about financial wellness for kids and grandkids. So, through our previous slice of advice meetings, we asked, what topics are you interested in that you'd want to teach your grandkids about or that you need help trying to discuss with them? And you guys came back with list after list, all of these ideas, and I took them all and I compiled them into my biggest 7 tips to help you talk to your kids and grandkids, or ideas to help you set them up for financial wealth and success. So hang on as we go through this list today. I'm excited. It's going to be fast paced and moving, but I promise you're going to take away some helpful tips and information. Okay. So we're going to hop right into it with number one. Guys, biggest thing, this is on you. Leave a legacy, not a liability. So what I'm trying to set you up for here is be sure and pass down assets, not debts. So consider the way that you're living right now. The last thing that you the last thing that you want to do is upon your passing have your kids be like, what in the world were my parents doing? How are we supposed to clean up this mess? We had no idea that they were in this kind of debt or had gotten themselves into this situation. So you may not be in a debt situation, but another way to look at this is like account consolidation. Do you have an old 401k that got orphaned? Do you have like 6 different traditional IRAs? Do you have an account with Fidelity, with Schwab, with Vanguard, and then like 13 other accounts all in different places? I see this more typically with like checking and savings accounts that might need to be cleaned up, but it's definitely something to look into for like make it as clean and simple as possible so that that transition phase for your kids when they're trying to pick up the pieces, it is super, super easy. Okay, the next biggest thing for leaving a legacy on your part is utilizing the tools that are already out there. So this is kind of this concept. Um, I see this more of a generational thing. So 2 generations ago, like the generation that grew up the beginning before the baby boomers, those that lived through the Great Depression, these are those that live just on Social Security checks. Like they actually did really well, but they saved everything because they lived through such hard times. It's like, I think back to my grandma washing and reusing her Ziploc bags because that's just what you did, right? Well, same situation is they lived on just Social Security checks because they want to pass on everything that they possibly could to that baby boomer generation or to their kids. And so as a result, like they sacrificed so much and lived so meagerly that their quality of life probably wasn't as great or as wonderful as it could have been. So this is a concept where what you do is you use a tool like life insurance to be like, if I have a certain dollar amount that I'm trying to leave 500,000 or 1 million or 2 million to my beneficiaries or my children, you can go out and get a life insurance policy for that amount of money, pay the premiums on that, but then spend the rest of your money. So you could effectively, that million you're trying to pass on, spend it entirely in your lifetime. And then upon your death, leave a tax free life insurance death benefit to your beneficiaries that your kids don't have to go out and try to like sell assets or do any of this stuff. They get it tax free. So, massive tools to use during your lifetime to make sure that you live a high quality, high standard of life, but also leave the legacy that you want in the most cleanest and simplest way to your kids. The other thing that I just want to throw out there is this concept of multi generational wealth starts with one person. It may be you, it may have been from the generation before, but it's a decision that someone made somewhere to work hard, to save, and to pass it on. And when you start establishing those patterns of work and savings and then gifting, you're setting up multi generations of wealth. So consider that in the decisions that you make. Are there things that we should be doing? Are there ways that we should be treating our money that we could really turn this into multi generational wealth and bless family upon family upon family line and keep that wealth rolling in the family? Okay, tip number 2, fund education the smart way. So, fun fact, 1 in 6 Americans actually still has student loan debt. the total student loan debt in America right now, as of 2025, is 1.77 trillion, trillion with a T, dollars. If you are trying to come up with ways to help your kids or grandkids succeed, see what you can do around helping to fund education. Now, this isn't the answer for everyone. You may not have the means to do it. Um, but this, because of the cost of living, the cost of housing, the cost of education, the inflation that we've gone through in the last couple of years, this is a massive way to give your kids and grandkids a leg up. So, the thing that you need to do is understand, do you know the difference between a 529 account, a Coverdell education account, or whether or not you just need to use an UTMA for your kids or grandkids? So a 529, these are state-sponsored plans. They usually have some kind of state tax benefit. In Idaho, you can write off up to $12,000 between a married filing jointly couple for contributing at least that amount into a 529 for a child or grandchild. How it works is a 529 has to be used for an accredited university or school. It could be used for K through 12 education as well, for like a private school. But these are all governed, again, by investments dictated by the state of Idaho that they've picked. So that's the 529. Then there's the Coverdale, that has a limit of $2,000 per year that can be put into it, where the 529 is just limited to the gift exclusion amount per year, which is 19,000 for 2025. So you could give 19,000, your spouse could give 19,000 to a grandkid. It'd be very, very generous of you to do that. But the Coverdale, on the other hand, $2,000 per year. The difference is it is not governed by the state of Idaho, which means you get to actually pick the investments inside of it. So if you don't want the mutual fund option that 529s typically go with, Coverdale is more of the route for you. However, to get the tax benefit and savings of using this education savings account, like a 529 Coverdale, it has to go to an accredited university. So what happens if you've got that grandkid that's like, this might be my beauty school dropout? Well, that might not be the account for them, because if they try to use money for that 529 or Coverdale for anything other than education, the growth inside of that account is taxable to them. So you might be wanting to use what's considered the UTMA, or called the UTMA, an underage transfer to a minor account. So this account, it's similar to a brokerage account, but it allows you to be the custodian over it until the age of attainment, which is 21 in the state of Idaho. So this means that you can help control the amount of money that's going in, how they're spending it, how the investments work, but also it's an opportunity for you to teach them how to use the money, but then they can pull it out for anything, whether it's for education, whether it's vocational, a trade school, beauty school, or if it's just like to help fund a mission, or purchase a car, down payment on a house, just get started in life. The proceeds, or the growth that happens on the money that's invested inside of one of those UTMA accounts, it is taxable, but it's taxable to the beneficiary, or your grandkid or kid that you would list on this account. So it's one of those things where, right now with federal tax law, if your income as a single file taxpayer is under $40,000, you don't pay taxes on capital gains. So distributions from an UTMA account are technically counted as capital gains distributions. So when I'm considering like my kids in their 20s needing to pull money out, whether it's to pay for college or a wedding or whatever, chances are they going to be making more than 40 grand and have that 40 grand in income that would make those gains taxable to them as long-term or short-term capital gains? Chances are probably not. And so they're not going to pay anything on those distributions from those accounts, and they're going to have freedom to be able to use the money for whatever they need. So just understand how those accounts work and which one's going to be best for getting your purpose for helping your kid or grandkid through that next stage in life. The other thing that you need to consider about funding education is it should not sacrifice your retirement. So I love when I meet with clients and they are like, yes, I want to do this, but I'm looking at them like, you can't afford to pay for education. Understand the balance between the responsibility of this is what you're willing to bring to the table without jeopardizing your ability to pay your own bills. Because remember, our tip number one, leave a legacy, not a liability. This can get you into trouble if you're not careful. And that's where the third point for my funding education comes in, which is discuss your expectations and set boundaries around this. This may mean like, hey, I want to help cover $10,000 of your tuition for the entire time you go to school. Or you might be able to say like, I'm willing to set this account up with 500 bucks, but I want to help establish patterns for you to be able to contribute to this 529 moving forward so that you have money set aside for college and savings. So just know there are lots of options out there, obviously, because of scholarships and different grants, all of those things. You want to push your kids and grandkids to be the best and to do a lot on their own. However, this is definitely one of those ways with the rising costs of education. If you have the means, you can really help set them ahead so they can focus on education, get through the schooling system, and into the workforce where they can start earning and saving money on their own. Okay, this brings me to point number three, give while you live. So, the purpose and concept of this is you can, if you're giving away money during your lifetime, you're going to reduce your taxable estate. So there isn't an estate tax in Idaho, but there is federal taxes on your estate when you start getting in the multi-million dollars. So you may not fall into that category where your estate's going to be taxable. However, you may have assets that are taxable no matter what, like traditional IRAs, 401ks. These pre-tax dollars, because of the Secure Act 2.0 that went into place in 2019, they, when they're passed on to the next generation or to your children, because you didn't spend all of that money in your lifetime, you got the tax break in your lifetime with the intent of having to take distributions and then pay taxes on it. That still applies to your kids. They just have to do it in a shorter period of time. They don't get the rest of their life. They have 10 years to cash it out. So why not spend the money, pay the tax, use it to do something for them? You can use this to teach kids valuable lessons, like use wisdom. The best learning resource that they're going to have is you. You've already experienced some hard things. You've done things that they have not. You are in the best position with your wisdom to be able to share with them. These are some of the mistakes I made when it came to money. I don't want to see you do that. That's why I want to use money now to help you with whether it's a down payment or purchasing a car, or maybe it's creating family memories where you're like, I want to help get you to this family vacation so we can create memories together. You decide. The cool part is it's just you have the ability to be in the driver's seat for helping them understand the value of money through that. And when you do this, you're not, you're instilling these money habits as far as like being generous and having a really great attitude towards money and this concept of abundance as opposed to scarcity. um, Money habits, it's huge. We just like a lot of how we spend money and treat it is based on what we've seen from our parents or those closest to us. And it sets this trajectory for how we move forward with it. So when you are using your money during your lifetime instead of waiting till you're gone to pass it on, this makes it a lot more easy for your kids and grandkids to learn proper techniques and spending habits in their lifetime. Okay, this brings me to the next point. You have to start early. You have to start when your kids are young. And for some of you, you might be like, well, my kids are grown and now it's just grandkids. So, how do you get involved? What is it that you do? Well, you teach savings. So, this might be through, your, there's rarely a birthday card that comes to one of my children that doesn't involve some cash from a grandparent or an aunt or an uncle in it. So, what do you do with that? We talk about savings. And maybe instead of being like, when I was growing up, it was like, oh, you can do this and we can take you to the store and you can buy something with it. Now it's like, hey, that 20 bucks that Mimi and Poppy gave you, if you want to put that in your savings and leave it there, as parents, we would be willing to match that money and watch it compound and grow for you in the bank. So there's some concepts like that that you can do where you're like, hey, don't just run out and spend it. You got to teach them early. Good debt versus bad debt. This is where you're explaining to grandkids, like, there's three things that are commonly taught that are acceptable to go into debt: a modest car, a modest home, and education. So beyond that, like you have to teach them that, you know, you are going to get offers for a credit card. Just school shopping this last week with my kids. They're like, oh, we can save you $40 on your purchase today. You just open this credit card. And my 7 year old's like, that's a lot of money that you could save. And I'm like, yes, but the interest and all of that and trying to deal with another credit card is not worth the headache. So it was a teaching opportunity for me there. And that comes down to one of the other points, using responsible or credit responsibly, like teaching them. Yes, unfortunately, credit is a game and you have to learn how to play it. So you may consider, like, whether it's with your kids or grandkids, co-signing on loans or whatever it takes to help them get credit established so that when need be that they have a great credit line out there, but teaching them, like, hey, when you're 18 you're not going to just go open a card just so you can save 20 bucks on a pair of jeans at the mall. Like, that's when a lot of these teenagers end up getting in trouble because they didn't have the financial wherewithal or background to understand, like, oh, I didn't know about the interest, I didn't know about the cash advances on credit cards, that they have like a 39% interest rate on them. Those are the things that you, through your wisdom, can help share. And then the biggest thing about teaching them early is just modeling the budget and spending. I'm always amazed when I'm meeting with people for the first time in their 50s and 60s, and I'm having to tell them, you need a budget. You need a budget. And it's not that you don't have enough money, but I find that when you like figure out for yourself where you're spending your money, you will want to make changes on your own, whether or not it's because you need to or you have to, but you're going to want to when it's like, I had no idea I was dropping this amount of money on something so frivolous or irrelevant to my overall goals or plans just because I didn't know that I was spending that money. And that's what budgeting does. It helps teach early on, like, hey, curb your appetite, practice some patience, and uh, don't get so wrapped up in that instant gratification. Like, practice spending. If there's something that you want, we're going to create a budget and we're going to work towards it so that we can save and have the money to do it, even if you have the money already in savings to do it. This is a really great way of teaching your family members, hey, it's okay even to have the money, to be smart about how you budget and set financial goals for what you're trying to accomplish. All right, that takes me to my next point: encourage ownership, not entitlement. It's so crazy because in this industry, I've had the amazing opportunity to meet lots of families with some of the most incredible amount of means possible or imaginable. And what's funny is I see people that sit on both ends of the spectrum where it's like they could never, ever possibly want for any more money, but they're so um, unhappy. And it's crazy because there's this sense of entitlement, like, I need more, I deserve more, I want more. And this comes from this concept of, like, and I'll talk about emotional and mental health around money here in a sec, but this sense of entitlement and the purpose behind the emotional wellness and financial wellness for your kids is you have to teach them the importance of hard work and savings so that they have this sense of accomplishment, or that it's just not that, hey, I get to sit back, or hey, I need to be bailed out of every situation. It is perfectly fine to tell your kids no when it comes to money. That is some of the best ways that they learn how to figure things out financially for themselves, and also creates a situation where they will learn to handle and cope or budget and curb their spending, as opposed to, like, hey, I got myself into another financial situation and I'm just looking for a bailout. Um, One of the coolest things that I saw around this concept was it's called the family bank. And right out of college, I went to work for a family that they're big venture capitalists in this area, but they had a spending allowance for each one of their children that was totally based on their kids' willingness to invest and start businesses. So they were granted X amount of dollars each month if they would propose their business and then meet with us as a team of advisors to be like, here's our business plan, here's my marketing, here's how I'm spending it. And then we would then in turn, like, release the funds to them each month. And then if they decided, like, hey, I'm done, I'm shutting down this business, or I want to like, it just didn't work out, the funds stopped. We didn't grant them the money. But the concept here was that this bank was there so that they would not just be entitled to be like, we know that there are millions of dollars to inherit. It was like, we have to build our own network of success. We have to build our own business. And there was a family bank there that was used to help funnel that. So they didn't have to go to the bank to start this, but they did have to check in with us to be like, this is how we get the funds to do it. So I know not everybody's in that position to be able to funnel thousands and thousands of dollars to their kids each month for their different business endeavors, whether they are successful or flop. The bigger point is you may just establish like there might be some little business venture that you're willing to help your grandkids fund, whether it's the lemonade stand or my children started a bracelet making business where they were selling their bracelets to the neighborhood kids and did really quite well. But I was their seed money for making sure that started. But I didn't lend them the money until they came to me with a business plan around it. So just another cool concept to help them understand like I wasn't entitled or I didn't, they weren't entitled to just get money to do these things. They had to show their work effort. And that's what was most important, teaching them how to work. Okay, next tip is to minimize taxes and maximize the impact. So, what this means is during your lifetime, you need to make sure that you're taking advantage of conversions from those traditional IRAs and 401ks into the Roth for tax-free inheritance. So, yes, you might not have an estate tax, but you, because of that Secure Act, those accounts, they have 10 years to cash out those pre-tax and even after-tax accounts. So there's a lot of planning that needs to go into it. And that may mean Roth conversions in your lifetime may not benefit you. It may cost you more in taxes, but it might set it, well, it will definitely set them up if they don't have to pay taxes on it and do that on a compounded situation that will impact their personal taxes too. So this is one of those conversations that you may need to have with us, with your CPA to see like it might not benefit you, but what it will do for your kids and grandkids will be massive. The effect of your money stretching even longer can go for miles instead of just inches. The other thing is use the tools like a trust. So if you need to control your asset, if you have a kid where you're like, ah, gosh, I thought they did a good job, but they just spend and spend and spend, and I know that they're going to get this money and just blow it. This is when you use a tool like a trust to be like, a trust helps control your asset beyond your death. So you can be like, you're only going to get X amount of dollars per month or amount of dollars per year. This will allow them to curb spending, and that you can't break that. You have to stick to the confines of that trust to make sure that your wishes are carried out. This also helps with like the gifting strategies, making sure that, again, I kind of mentioned like life insurance, but there's other types of trusts that can be used to gift. Trusts don't solve the problem with taxes, but it can just structure it differently so it can alleviate the burden or make sure that you receive assets tax free, like life insurance. The other thing that is comes up commonly because I do a lot of work with the estate planning is what's understanding the difference between fair and equal when it comes to distributions from trusts. A lot of people are like, oh, I have to be totally fair and equal between my kids. So if you have four kids, it's 24, 25% each of them. Each kid's in a different position. And sometimes one kid has worked harder, saves better, has more money. They are going to be in a better place. And there's some that are just like, they're going to blow it. Is it fair to reward those or to have to like pay off all of the debts of those? Like, this is one of those situations where you teach your kids, like, maybe you don't forgive debts in your estate plan, where it's like, hey, I've lent you several $100,000 over your lifetime because of some of your poor mistakes. And I don't think it's fair that your sibling that's done a really good job saving gets less money as a result because I've given more to you during my lifetime. So this is one of those concepts where you have to decide what's fair and equal based on who's going to do the best good with your money and carry out the wishes that you might have for them as well as their own. Okay, so this brings me to the seventh and final topic, which is about emotional wellness when it comes to money. So I know I talked about attitude a little bit, but this is huge. If you have an attitude of abundance when it comes to money, that is when money flows freely. If you have this scarcity concept, it will never be enough. You could have all the money in the world, and I've seen this families all the money, right? But the kids are entitled. And it's like, my parents don't give me enough. They're constantly calling for more money. They're just genuinely unhappy. And it blows my mind. But I've also seen the flip side where the parents are like very, very generous. And it's like, it's not that they're giving it away without just freely, but it's like, hey, I want to help you. I want to help you with the down payment. I'm giving to charity. I'm doing all of this. This attitude passes on, and your kids and your grandkids see it. The way you treat money is the way that they will want to treat money. Granted, I have twins. I understand that each kid comes with their own attitude towards it, no matter how much nurturing versus nature is involved. I understand that point, and you can do everything to try to teach them and force them, and they still have their natural inclinations for how things work. However, I can tell you that a general attitude towards it will have a very massive impact about how they feel towards money. If there's never enough and you're always feeling like you're getting worked over, that attitude passes on. Choose abundance, choose wealth, choose generosity. It's those families that I see that are very generous and willing to help. And it's not that they don't have boundaries or set expectations or talk about what it is that they're willing to do and they just give everything. That's not the case. They're very clear about how they want to help. It's just this mindset that really changes the difference. Through this process, you get to teach responsible decision making. You get to help them learn for themselves. Is this something that's worth spending the money now? Do I sacrifice my time or like my future work efforts to have something now that I could wait for? It's just, again, this overall concept. You're cultivating confidence through it. You're teaching them, I can work for things. I know how to work hard. It means so much more to me when I've worked for it or understand the sweat equity that went into owning this or purchasing this, buying my investments, all of it. Um, Nurturing this healthy mindset again starts young, but it's a responsibility. And um, lots of opportunities out there to help your kids and grandkids through your planning, through your wisdom to be able to pass on those things that you've learned. Um, Guys, those are my 7 tips. And what I'm thank you for hanging in there with me. These are our disclosures that the lawyer says that I have to share. But just understand that your responsibility in helping set your kids up only goes so far. Like you can do so much and they will always just have their own choices in the end that they're responsible for making. But I can assure you that your attitude towards money and the small steps that you take and being willing to spend time with them, share your wisdom, that that knowledge is power and that experience is invaluable. Please take the time to share that with your kids. If there's any way that we can help be a part in facilitating those discussions, please let us know. If that means coming in, sitting down, and we run a family council or we talk about your plans, what it is that you're hoping to accomplish with your money during your lifetime and after, so everybody's on the same page, we are here to help. We appreciate your trust. We are thankful to be a part of your financial journey, and and thank you for that responsibility and allowing us to be a part of it. With that, thanks for hanging in there. I appreciate your time. Let us know how it can be helpful. Have a great day. Thanks.